Chapter 4. Adjustments, Financial Statements, and the Quality of Earnings. Management bears the ultimate responsibility for the preparation of financial statements. High-quality financial statements are those that are considered relevant and reliable to the user. Here is another look at the accounting cycle that we previewed in the last chapter. In this chapter, we will devote a significant amount of time toward learning about adjusting entries. As we have learned in previous chapters, the matching principle requires that revenue be recorded when earned and expenses be recorded when incurred. But some transactions begin in one accounting period and are not completed until the following accounting period. So at the end of each accounting period, we need to make proper adjustments to ensure that all the revenue has been recognized and all the expenses are recorded in the proper accounting period. There are 4 types of adjustments. Unearned revenues represent previously recorded liabilities that were created when cash was received in advance, and that must be adjusted for the amount of revenue actually earned during the period. The second type of adjustment is accrued revenues. Accrued revenues represent revenues that were earned but not recorded because cash was received after the services were performed or goods were delivered. Prepaid expenses represent previously recorded assets, such as prepaid rent, supplies, and equipment, that must be adjusted for the amount of expense actually incurred during the period through the use of the asset. Accrued expenses represent expenses that were incurred but were not recorded because cash was paid after the goods or services were received. The trial balance is a listing of all the account balances in our general ledger. The total of all debit balance accounts should equal the total of all credit balance accounts. When this occurs, we can say that the books are in balance. Here's an example of the trial balance at the end of the year. Notice that the total of all the debits is equal to the total of all the credits. 2 of the accounts listed on our trial balance are accumulated depreciation associated with the equipment, as well as associated with furniture and fixtures. Accumulated depreciation is a contra asset account. A contra asset account is directly related to an asset account and reduces that account balance. For example, if we take the balance in the equipment account and subtract the accumulated depreciation, we have what is known as the book value of the asset. The contra account, accumulated depreciation on equipment, reduces the equipment account balance on the financial statements. Here is an example of cash being received in one accounting period, but the revenue is not earned until the following accounting period. An example of this type of transaction would include rent received in advance. In this example, Tom's Rentals received a check for $3,000, representing the first 4 months' rent from a new tenant. Since no service has been provided to the new tenant, we must recognize an unearned revenue account. The journal entry at December 1st is to debit cash for $3,000 and credit unearned rent revenue for the same amount. The unearned rent revenue account is a liability account. On December 31st, it's necessary to make an adjusting entry to recognize the revenue earned as a result of providing services to the tenant. The entry is to recognize 1/4 of the total unearned rent revenue. The journal entry at December 31st is to debit unearned rent revenue for $750 and credit rent revenue for $750. Our journal entry reduces the liability, unearned rent revenue, and recognizes the revenue earned. The journal entry posted to the T accounts for unearned rent revenue and rent revenue looks like this. The rent revenue will appear on the income statement for the month ended December 31st, 2009. Any unearned rent revenue will appear as a liability on the balance sheet. Here is a demonstration of revenue being earned in one accounting period, but the cash is not received until the following accounting period. An example would include interest earned on a savings account balance. At December 31st, Matrix Incorporated earned but has not received interest on its money market account of $150. The adjustment is made to debit or increase to interest receivable and credit or increase to interest revenue. After posting the adjusting journal entry at December 31st, the two T accounts will each have a balance of $150. A deferred expense is one in which cash is paid before the expense is recognized. Examples would include prepaid rent or prepaid advertising. On January 1st, 2009, a company pays $3,600 cash for a 3-year fire insurance policy. On the date the policy is acquired, the company will debit prepaid insurance expense for $3,600 and credit cash for the same amount. The prepaid insurance expense is an asset account and will appear on the balance sheet. The insurance policy will expire over the next 3 years, and the company will receive 1/3 of the total cost as a benefit in each of those 3 years. The adjusting journal entry on December 31st, 2009 is to debit insurance expense for $1,200 and credit prepaid insurance expense for the same amount. The asset account, prepaid insurance expense, will be reduced, and the expenses will go up by $1,200. Immediately after posting the adjusting entry, the balance in prepaid insurance expense will be $2,400. This represents the remaining 2 years of unexpired insurance. The prepaid interest expense is an asset account and will appear on our balance sheet. The insurance expense will appear on our income statement for the current period. An accrued expense is one in which the expense is incurred in one accounting period, but not paid until the following accounting period. Examples include accrued rent, accrued interest, and accrued wages. Part 1. On December 27, 2009, Denton had already paid $1,900,000 to its employees as wages for the year. Denton pays its employees every Friday, but this year, December 31st, 2009, falls on a Wednesday. As of the end of the year, employees earned a total of $50,000 in wages, but they will not be paid until the end of the week, Friday, January 2nd, 2010. What adjusting journal entry do you think is necessary at December 31st, 2009? Part 2. On December 31st, 2009, Denton will debit wages expense for $50,000 and credit wages payable for the same amount. The expense must be recognized in the period in which it was incurred, even though it will not be paid until the next period. After we post the adjusting journal entry, the balance in wages expense will be $1,950,000. Of course, wages expense will appear on the current period income statement. Wages payable is a liability and will appear on the balance sheet. In addition to the adjustments we've already discussed, we also have adjustments involving estimates. Examples of common accounting estimates would include depreciation expense, bad debt expense, and income taxes expense. Most companies use the statement of stockholders' equity rather than the statement of retained earnings. The statement of stockholders' equity explains the changes in retained earnings as well as changes in other stockholders' equity accounts. We know that we begin the process of preparing the financial statements with the income statement. Part 1. Once the income statement has been prepared, we can move on to the statement of retained earnings. Part 2. Net income increases retained earnings, and dividends decrease retained earnings. Retained earnings is combined with contributed capital to form stockholders' equity. Retained earnings is combined with contributed capital to form stockholders' equity. Stockholders' equity is one of the three major portions of our balance sheet. We know that assets equal liabilities plus stockholders' equity. Here is the income statement for Papa John's for the month ended January 31st, 2007. Earnings per share must be reported on the income statement. To calculate earnings per share, divide net income by the average number of shares of common stock outstanding during the period. Notice that during the month, Papa John's earned 23 cents per share. Net income is $7,689 and will flow forward to the statement of retained earnings. Here is Papa John's statement of stockholders' equity for the month ended January 31st, 2007. You can see that net income increases retained earnings and dividends decrease retained earnings. The balance in the retained earnings account is $151,689. This amount should flow forward to the stockholders' equity section of the balance sheet. On this slide, we have the assets section of Papa John's balance sheet at January 31st, 2007. Notice that accumulated depreciation reduces the cost basis of property and equipment. This is the liability and stockholders' equity section of Papa John's balance sheet. Notice that the balance in retained earnings is $151,689, the amount that flowed forward from the statement of stockholders' equity. As we have seen before, the statement of cash flows is divided into three major sections. 1. Operating activities. 2. Investing activities. And 3. Financing activities. For complete disclosure, companies are required to provide supplemental information on the statement itself or in the notes to the financial statements. These disclosures must include 1. Cash interest paid during the period. 2. Cash taxes paid during the period. 3. A supplemental schedule showing significant non-cash investing and financing transactions. For example, if the company issued common stock to purchase a building, the transaction would not involve cash, but must be disclosed because it involves both a financing and an investing activity. Part 1. Net profit margin is determined by dividing net income by net sales. The net profit margin is an excellent indicator of how effective management is in earning profits from every dollar's worth of sales. Part 2. For 2006, Papa John's net profit margin was 6.33%. All balance sheet accounts are carried forward from one period to the next, but income statement accounts are not. Income accrues over a period of time. So, at the beginning of each new period, we start accumulating revenues and expenses all over again. It is necessary to zero out all revenues, expenses, gains, and losses at the end of each accounting period. We transfer all income accounts to retained earnings. We already know that net income increases retained earnings. The closing process is the way we transfer that income into the retained earnings account. Only the accounts listed on this slide are closed. They include revenues, expenses, gains, losses, and dividends declared. All of these accounts are referred to as temporary accounts because we zero them out at the end of each accounting period. Balance sheet accounts are referred to as real or permanent accounts because they carry forward from one accounting period to the next. Closing our books is a two-step process. First, we close all revenue and gains to retained earnings. Second, we close all expenses and losses to retained earnings. Let's see how this two-step process works. Part 1. Revenues and gains both have a credit balance before closing. To close a revenue or gain account, we must debit that account. So, the entry to close out Papa John's restaurant sales revenue is to debit restaurant sales revenue for $66,000 and credit retained earnings for $66,000. Part 2. After we post this closing entry, the restaurant sales revenue account will have a zero balance, and the $66,000 will be transferred to retained earnings. Part 1. Expenses and losses have debit balances before closing. To zero out an expense or loss account, we must credit the account and debit retained earnings. As you can see on the screen, Papa John's closed its cost of goods sold with the debit to retained earnings for $30,000 and a credit to cost of sales for the same amount. We would close all other expenses and losses in a similar manner. Part 2. After this closing entry has been posted, cost of sales has a zero balance, and the $30,000 has been transferred to retained earnings. After all revenues, expenses, gains, and losses have been closed, the balance in retained earnings has been updated for the net income or loss during the period. Assume that dividends declared are recognized in a separate dividend account. This separate account will be closed directly to retained earnings at the end of the period. The balance in retained earnings is $151,689. This is the amount that will appear on the balance sheet. After all temporary accounts have been closed, we prepare a post-closing trial balance. Only assets, liabilities, and stockholders' equity accounts will appear. All revenue, expense, gain, and loss accounts will have a zero balance. Companies that tend to make relatively pessimistic estimates that reduce current earnings are judged to have a conservative financial reporting strategy. Financial analysts and many investors prefer this strategy to any other. These companies are thought to have high-quality earnings. End of Chapter 4.